talk me through the message that is embedded in the fact that Saudi Arabia and Russia are going to be extending these voluntary cuts.
Hey, Guy. Yeah, I think we've had several attempts by media, by other sources, to sort of poison the well of OPEC in the context of unity, in the context of coherence, consistency. And so what this message today is essentially focused on the fact that unity is as good as it can be. You have record cuts by the two largest producers. The fact that Russia has come in to cut through the summer, which is sort of counter-seasonal, quite unusual, tells you that the alliance of OPEC Plus is very strong. But moreover, that what Saudi is trying to achieve here is mitigating downside volatility, not necessarily trying to protect constantly a price that the market wishes there was, or some sort of put option. I think this is very much anchored on giving stability to the market as opposed to a price target per se, and therefore getting Russia involved is absolutely consistent with that.
So that's the Saudi story. Walk us through the Russia story here. The voluntary cuts from Russia are a little bit of a surprise. How much of that is a function of need as opposed to want?
I think absolutely. I mean, look, we've had slowing demand, particularly for goods. Manufacturing demand is weaker. A lot of the data points that have come out from the industrial and capital goods companies is suggesting that. So in some ways, there is a timely move here in terms of countering that softness. But moreover, I think ultimately there's been some question marks as whether Russia has indeed been cutting. Now, our data through our commodities team suggests that they are cutting. I think ultimately the message today is not only are we cutting, but we're going to go over and above that call of duty in the same way that Saudi has done through its unilateral 1 million barrel cut, which is extended to August. And so I think ultimately this is a push and a pull, driven by softer demand more globally, but ultimately led by a focus on stability.
Christyan, there is one way of looking at this, and that is that they are signaling that they don't expect the market to tighten, as everybody else seems to at the moment, in the second half of the year.
I think you are right. I think a lot of question marks as to what are the optics. What does this mean that demand is significantly weak, or is this ultimately trying to provide or inject more stability, particularly to protect the downside? I think we've expressed those views in the past around the softness on demand, particularly in the April cut. But we've changed now. I think ultimately demand is very robust when you look at it through the metrics of mobility. When you look, particularly industrial demand, now it's been reset. We see growth into the second half. So really, I'd see this as far more of a cut through ensuring stability, protecting the downside. Put another way, they could produce this volume and the market would absorb it. But really, if you're solving for reducing global stocks, which has ultimately moved the wrong way over the last few months, then this is the right move. So it's not necessarily about demand per se, it's about stabilizing those stocks that have actually grown, particularly that dark inventory that we inherited through the start of the year, and particularly given we have other countries that are producing unexpectedly higher than we thought, such as Venezuela, Iran, and to some extent Libya.
Well, talk to us then about the UAE story here. If you have the Saudis cutting, you have the Russians cutting, how long before the UAE cuts as well?
Well, the UAE have pledged a cut, and they've succeeded in generating a high quota. Ultimately, the message from the UAE is that they're very supportive of doing whatever it takes in order to provide stability. The oil minister Al-Mazrui has done an excellent job ensuring that alliance continues through their own compliance, which is in line with the peer group. A second point I'd make is that with the UAE actually cutting and potentially proposing a bigger cut, that will be unto them to do so. So this is very much a unilateral. Everybody's invited. If you want to cut, but ultimately everyone's got a framework and a quota that they're working towards. So it's a great question. Who knows? But in the spirit of, again, unity and compliance, they've all got a vested interest to ensure we get through this period of volatility. And ultimately, the proof is in the pudding. Look at the oil price. Look where it's gone in the last few months. OPEC has done an excellent job tightening that range. And having just been to see Shell CMD recently, you can see the messaging from the corporates is very much, well, now that we have more stability in the oil price, there's less volatility, we can start to plan our investments. And you've seen exactly that, most recently with Shell raising its upstream capex, particularly knowing that they've got the central bank to sort of got their back, as it were.
Christyan, you're going to Vienna. What question are you going to take? What question do you want to hear the answer to?
I want to understand, just very much as you're asking, how if we are in a period of demand discovery, rates have gone higher. We aren't sure as to how that will play out through goods and industrial, the industrial part of the barrel in terms of demand. How is that trending? There's a lot of question marks around recession, whether it's arrived or not. And we are in discovery, particularly given the fiscal tightening that we've seen and its impact on the consumer. So I would like to see from OPEC what they're seeing in the context of the demand trajectory further out, maybe 6 or 9 months, particularly as we think about quotas in the framework for OPEC beyond this year. That would be the key, I think, one of the key messages that I think OPEC should work towards, because that outlook on demand is where I think the market is generally schizophrenic and unsure of. Supply is clearer, arguably, but demand, the trajectory of demand, has been quite unstable and harder to gauge.
So why are you then so sure of a 2023 average of an 81 price target essentially on Brent at a time, by the way, when we get these headlines of cuts over and over again, and you haven't really seen Brent or WTI cross that 75 and 70 level respectively?
It's ultimately a race to the bottom. Demand is weaker, but supply is even weaker, particularly in the response to that demand, in response to oil and the volatility of oil. Shale, the rig counts have markedly slowed down. If you talk to any of the majors, they do have oil and wells that can tie in. This is outside shale. But the reality is we're running out of cigars in the box, if you will, right? It's harder to source those wells. Uptimes have moved to a level now where efficiencies have capped out. So we are sort of, like I said, the clock is ticking in terms of that next quantum of volume that we can see emerge outside of shale, outside of OPEC over the next 2 to 3 years. And look, we've all talked about the underinvestment thesis. It's a sort of believe it when I see it. But ultimately, we've said we've never seen underinvestment like this, particularly outside of shale, led by the majors who are very much focused now on cash return. So the clock is ticking. If demand recovers, and we're caught out, particularly as shale has normalized, it's kind of coming out of a growth period into more of a sort of a steady growth period, then we could be surprised. So I reckon the key blind spot here isn't oil price to the downside, as we warned earlier in the year. It's a major spike to the upside as we start to unravel the missing barrels, as it were, in the fact that supply is starting to really fall short. So race to the bottom of supply demand for sure.
Christyan, 30 seconds here. This was exactly what we heard a year ago in the onset of the war in Ukraine from a lot of the shale heads of shale over at CERAWeek. Has anything changed in that investment case? You're saying that shale has normalized. To what extent is that true?
To what extent it's true is that the volume growth that we're seeing this year, ultimately you see headlines like record volumes for this year. That's what we expected, but the rate of change has gone from 1.5, 1.6 down to now 600 to 700,000 barrels. That is called normalization. And the one thing I'd argue is that when you look at how the Saudis have managed their barrels and their fields out 200 years, they have optimized their geology brilliantly. You look at what happens in shale the last 10 years, they've blown up, they've fracked very aggressively, and so that productivity, you reap what you sow, is slowing. As that productivity slows because of the way they dealt with those wells, forget how much, that's probably what's going to come out first. Then you have higher interest rates. If interest rates stay high, flow of capital stays limited. That will be the main bottleneck for shale growth. You just can't access the dollars that you used to grow volumes in the way you used to. That's, I'd argue, structurally changed over the long term.